Hello, everybody, and welcome. My name is Bennett Tchaikovsky, the accounting professor, and today what we're going to be looking at, this is a concept in managerial accounting, is we're going to create financial statements, meaning we're going to create an income statement, a statement of retained earnings, and a balance sheet from a cash budget. So my disclaimer and copyright notice, the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or California State University at Fullerton. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. My presentation is copyright 2008 to 2023 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. And then basically, you can disregard the last one. It's part of a larger video series that I'm doing that I have not yet completed about how to go through instant cash budget for your business. So before I get to that, right over here, let's go through and take a look at the question we're going to be going through and working today. So if you're taking my class in chapter 20 for managerial accounting, what I'm really trying to kind of go through and do is to get you to understand how to do a cash budget, as well as how to create financial statements from that cash budget. And so for this question, where I'm modifying this question from the one I previously did, this is a modification of this multi-month cash flow, but this is right over here. And what I'm going to be doing for this question is I'm going to be giving you the statement of basically the cash flow statement, which is for this purposes is I start with my beginning cash balance. I have collection of AR. I have cash sales, total cash available, accounts payable payments, cash paid for interest, cash paid for insurance, cash payments for purchases, cash paid for dividends, total cash outflows, and then I have an ending cash balance. And what we're going to do is we're going to take this information and we're going to turn it into we're going to turn this into the following. We need to go through and prepare a budgeted income statement, a budgeted statement of retained earnings, and budgeted balance sheets as of March 31st and April 30th. Okay. Let's go ahead and move this over here. Okay, so here we go. So if I'm going through and doing an income statement, right? So right over here, what is an income statement? I'm going to have YYZ income statements for the months ending 3/31/22, 4/30/22. So I have this up here in terms of what I went through and collected in terms of cash, and I have to turn these into income statements. So let's go through and start. When we're doing our income statement, it's going to be our revenue less our expenses. So let's go over here and take a look at revenues. Okay. So over here, it tells us here the beginning balance is over here. Then it gives us other cash payments or receipts. Cash sales was 100 for March. April it was for 120. Cash payments for purchases are 50 and 60. Cash paid for insurance is 24. Cash paid for dividends. And if you look at the chart over here, you'll notice that, oh, cash sales, those are showing up as cash inflows, right? These are inflows. Cash payments for purchases. Oh, right over here, the 50 and the 60. Cash paid for insurance are 24 and 0, right? So as we look at this over here, let's go ahead and take a look at revenues. Well, what goes into my revenues? Well, if I'm not given any other information, okay, meaning that there were no cash advances received by a customer in revenue, what I'm going to go through and do is I'm basically going to say, okay, my cash sales must have been my revenues over here of 400 and then over here at 120. So that's basically my revenues. Now, What about this cash collected from accounts receivable? That's not revenue, because what that more than likely what happened is in a prior month, I made a sale on account. So maybe in February, I debited accounts receivable, I credited sales. Now in March, right? So this is February, and this would have been for 40 and 40. And then over here in March, I'm actually collecting it. So cash accounts receivable. So this 40,000 is not revenue in the month of March. So we're just going to go ahead and just leave that alone. Okay. Now let's go over here. So we have our revenues. Okay. Now I have to go to my expenses. Okay. So over here, the accounts payable payments, same kind of thing as the accounts receivable. That is not going to be an expense. It was an expense more than likely, potentially in the prior month. But if I'm just paying off something, if I bought inventory and I'm now paying it back, we're going to leave that alone. Cash paid for interest. Okay, so if I look at this over here, the loan bears interest at 6% annually, and interest is paid each month. So if the loan amount is 200,000, and the annual interest is at 6%. Over here, I've got annual interest of 12. If interest is being paid each month, this is going to be 12 divided by 12 months, or $1. So I'm going to have over here my interest expense of 1 and 1. Now, the cash paid for insurance of 24. Let's take a look at that. Right over here, it says the insurance payment during March relates to a policy that was purchased on March 1st and will provide 12 months of coverage. So in terms of looking at this transaction, in terms of T accounts, right, what did this look like? Well, when I made the payment, I credited cash for 24. And what would I have debited for this 24? Right, this 24,000 of the cash paid for insurance. Would I have debited insurance expense? The answer is no, because I haven't used the policy yet. So what this is going to be over here is this is going to be prepaid insurance. So right over here, this is going to be March 1st, 2022. And then this is also going to be March 1st, 2022. So very, very important. When you see this, do not assume that when I get to insurance expense, that I'm just going to go through and drop this number in. This is a prepayment, right? This 24,000 right over here is a prepayment of insurance. So this is an insurance payments during March that relates to a policy on March 1st and provides me with 12 months of coverage. However, if I'm doing a budgeted income statement for the month of March and the month of April, the question is, well, what's the value of my prepaid insurance account as of 3/31/22? Is it still 24? Well, the insurance policy is giving me coverage from 3/1/22 to 2/28/23, or it's giving me 12 months of coverage. Okay. So by the end of the month, some of this is expired, right? When I look at this on my balance sheet, when I show my assets, it has to show the future economic benefit. And it's no longer going to be at 24. So what do I need to do? Well, if it's a 24-month, if it is a $24,000 policy amount, and my months of coverage are 12, the amount of my monthly insurance expense is going to be $2,000 per month. So over here on my insurance expense, and again, how do I go through and record my expenses? Right? Remember, the T account, assets are equal to my liabilities plus my owner's equity. Expenses, revenues, Washington debit credit. I record expenses with a debit. I show an increase to an asset with a debit, like I did up here, decreases to an asset with a credit, which I did over here. I record expenses with debits, revenues with credits. Liabilities and equity typically have credit balances. They're increase with credits and decrease with debits. So over here, to record insurance expense as of 3/31/22, I'm going to debit insurance expense for 2. What do I credit? Well, if you go back and you remember your adjusting journal entries, I'm going to credit prepaid insurance. So what's my prepaid insurance account balance? Well, if I take over here, 24 minus 2, I get 22. When I see this 22, well, what does that mean? Well, 1 month of a coverage has expired. I now have 11 months left, right? I've got April, May, June, July, August, September, October, November, December, January, February, right? I've got 11 months left. So over here, this would be 11 months times 2 per month. So I know that that ending balance is correct. So when I come over here and in terms of insurance expense, I'm going to be recording $2,000 as of 3/31/22. Now let's take a look at the month of April. Let's go right over here. So now for the month of April, my beginning balance in prepaid insurance was 22. Right over here for my insurance expense, got to go through over here and kind of do the same thing, right? So as of 4/30/20, sorry, God, I'm skipping years, 4/1/22, and this is going to be 4/30/23. So is my balance this amount at the end of the month? The answer is no. I used another 2,000 of insurance expense. So over here, I'm going to adjust this for 2,000. And then over here, I'm going to basically show I'm going to debit insurance expense for 2, credit prepaid insurance. My ending balance for this one right here is going to be 20,000. Okay, so insurance expense, I'm going to go through and record this here at 2. Why did I go through and just take all these T accounts? Why am I going through and sharing this with you? It's because we're going to be asked to do a balance sheet. When we're asked to do a balance sheet, we're going to have to go through and show these amounts happening. Okay, let's go through and take a look over here at the next one. Okay, so I've got over here, I've got cash payments for purchases. And it tells me that this is really the same thing as cost of goods sold. I'm not making a multi-month income statement. I'm just doing a single step. So I'm just going to go ahead and say cost of goods sold is at 50 and it's 60. Okay, so what have I dealt with so far? I've got my revenues that came through. I'm only showing the current month in terms of being collected. I have my interest expense, I have my insurance expense, and I have my cost of goods sold. A dividend, if I pay a dividend to my shareholders, is that an expense? And the answer is no. That's going to go on the statement of retained earnings. It's a return to our investors. Does not go on our income statement. But let's look at some of the information and see if we can find out some more things. Over here, it says that the equipment was purchased on, so this 150 of equipment was purchased on January 1st, 2022. The salvage value of the equipment is 30 and will be depreciated straight line over 5 years. So when I look at this over here, I know that when I have something like this, oh, I need to record depreciation expense, right? Now, what's really important to remember is that when I'm recording depreciation expense, it's not going to show up here on the cash flow. Why not? Because when I record depreciation expense, I'm debiting depreciation expense and I'm crediting accumulated depreciation on equipment. Does it involve cash at all? So it's not going to show up on this. If I purchased equipment and it's showing up here, it's going to show as a big lump sum amount, but that's not going to be what I record on my income statement. So over here on our income statement, right, what I'm going to go through and do, and let's just say we bought this equipment at the very beginning of the year. So we have the acquisition cost, minus the salvage value divided by the estimated useful life. This is going to give us our annual depreciation expense. And if I look at this question in particular, this is a $150,000 acquisition cost. The salvage value of the equipment was 30, and it's being depreciated straight line. This is the equation for a straight line. This is the only method I will ask you for this question if you get it in accounting 1B with me. So this is going to be 120 divided by 5, or $24,000 per year. I guess I like the number 24. There was a really interesting movie with Jim Carrey. I think it was the number 23, but that was a long time ago, and I can't use those kind of references unless I get in my hot tub time machine, which no one gets. So this is my annual depreciation expense. Now, if I take this and divide it by 12, this is going to give me my monthly depreciation expense. Okay. So I come over here and I'm looking at this depreciation expense. How do I go through and record it? Well, we bought this equipment on January 1st, right? Let's go ahead and make some more T accounts, right? So on the equipment side of things, I bought this equipment as an asset. Unless it's a 7 Series BMW, then it's just going to be good for a slow speed chase. So over here, this would be 1122, 1122, and wow, Bennett, I am stuck in 2023. Okay. So right over here, and this is going to be cash. Now, when it comes to going through and basically recording depreciation expense, how do I do it? Well, the way I record depreciation expense is I'm going to debit the expense, which is going to be depreciation. And then I'm going to credit the contra asset account, which is going to be accumulated depreciation on the equipment. Now, when I look at my balance sheet as of February 28th, I notice this number here of 4. Where did that come from? Well, right over here, right? I've got over here, I said my monthly depreciation expense, so 130.22. This would have been 2, and I would have credited accumulated depreciation on equipment. Wow, I'm getting all my dates screwed up. Okay. I would have credited accumulated depreciation on equipment by 2. What happens in the next month? Well, this would be closed out to retained earnings. Over here, my beginning balance on 2/1/22 was 2,000. And over here, how much depreciation expense do I record during April? Well, on 2/28/22, I would have recorded another 2,000. And this would be over here, debit depreciation expense, credit accumulated depreciation on equipment. Right over here, my accumulated depreciation on equipment balance is now at 4. This is what is showing up on my balance sheet. You don't have to go through and do this, but I want you to make sure that you know where the numbers are coming from. Very important. So if we go through and look at this over here, right, is we kind of go, let's just go ahead and extend this for the next 2 months because it's relevant to us. So this is going to be over here, 3/31/22. This over here becomes my beginning balance. My beginning balance is going to be at 3/1/22 is going to be at 4. I take another month of depreciation. So my accumulated depreciation is at 6 by month end. Okay, so this over here, that becomes my beginning balance for the following month, or 4/1/22. Take another 2,000 of depreciation expense as of 4/30/22. And here is my ending balance in my accumulated depreciation equipment. Now, for our purposes here of the income statement, right, this part over here, my depreciation expense is just going to be 2 and 2. Chuck Woolery, Love Connection. See you in 2 and 2. But unfortunately, we're not watching Love Connection. We're watching The Accounting Connection, another dad humor for this beautiful day before 420. So right over here, when we kind of look at this, but why did I go through and do this? It's because when we make the balance sheet, this is going to become very important to us, right? All these balances here, because the prepaid insurance account is an asset and it's going to show up on our balance sheet. So let me just kind of go through and do a little bit of a recap. So we've got the interest expense, right? We dealt with that. We dealt with the insurance expense, right? We've dealt with these guys. We've dealt with the payable. The payables don't really impact us. The AR doesn't really impact us, right? We've dealt with the depreciation on the equipment right over here. And we've dealt with these amounts right up here. And let's go through and see if we see anything else. Receivables we've dealt with, cash, all those things here, payable. Okay, so we're good. So our total expenses are going to be right over here at 55 and 65. Remember, depreciation expense does not go on the cash flows, right? It's a non-cash item, right? So over here, depreciation expense, accumulated depreciation. So my net income is going to be 45. And over here, it's going to be 55. I'm just going to pause really quickly. Okay, so here are my income statements. Okay, now let's go to the next one. Okay, which is basically going to be my YYZ statements of retained earnings for the months ending 3/31/22 and 4/30/22. If for some reason you're looking at what I'm doing and say, I don't understand this, what I would suggest that you go through and do is that if you're enrolled in one of my classes in my managerial accounting class, like very, very important, right? The more important thing is if we don't know what we're doing, we have to go through and basically, figure it out. So if you come over here and you go to, let's see here. This is not the homework for 1B. If you go through these first two homework packets, it will teach you how to create financial statements. So again, if this is something you don't understand, if what I'm showing you up here doesn't make sense, please go back to that homework packet. You'll understand how to do financial statements after you go through and review it. Now, let's go over here and take a look at our statements of retained earnings. What is the statement of retained earnings? It basically shows how much of the net income did we go through and collect, or did we actually keep, or how much did we retain? Retained earnings statement, extremely important because it's going to lead us to the balance sheet. So we're going to start over here with our beginning retained earnings plus our net income minus our dividends is going to give me my ending retained earnings. So my beginning retained earnings is not 45. My beginning retained earnings is on my February 28, 2022 balance sheet. My beginning retained earnings over here was at 61. Okay, so right over here, it's at 61. I had net income of 45. Did I pay any dividends during March? No, I paid them during April. So over here, my dividends are going to be 0. So my ending retained earnings is going to be at 106. My ending retained earnings becomes the beginning retained earnings for the next period. My net income was 55. My dividends that I paid were 3,000. So my ending retained earnings is going to be 158. That's my statement of retained earnings. That's the bridge between the income statement and the balance sheet. Let's go over here to the balance sheet. Now for the balance sheet on the test, I believe that I'm actually going to give you where I will say, that's why I took a little break. I'm going to give you the asset. I'm going to give you the breakout, right? You don't have to show it on a classified basis, right? So we're going to show over here assets. Don't worry about current assets, but how do we start out our balance sheet? Well, we're going to start out over here with our cash. right? Our cash balance is going to be the ending cash balance that is shown on the cash flow. So this is going to be 190, and then it's going to be 246. Next one, what's my next asset? Well, one of the things that I went through and did is if I look at my other assets here, let's just go down the list. Accounts receivable, I collected that. So that went down to 0. Property, plant, and equipment. Let's do that one. So over here, we have PP&E. And for this one, I'm just going to make the little change on this just so I can kind of show you how I kind of go through and indent things. So my property, plant, and equipment was at 150, right? This is my on my balance sheet. Now, my accumulated depreciation is going to be how much? This is where the chart comes in. It was 4 at the beginning, or as of 2/28/22. I added 2,000 of depreciation expense. My ending balance is 6. So over here, this is going to be minus 6,000. This is going to give me property, plant, and equipment net of 144. Over here for the following month, it's 150. My accumulated depreciation on the property, plant, and equipment is at 8. Over here, ending balance is going to be 142. And let's just draw a little line right down here so we don't confuse ourselves. Okay. Now, next thing as I look at, let's look at our other assets. So got property, plant, and equipment. Now we're getting the liabilities, but one of the other assets I had was up here with prepaid insurance. As we saw, I bought this policy at the beginning of the month. Prepaid insurance is an asset. It's giving us future economic benefit in the form of insurance coverage. So over here for my prepaid insurance, my balance over here is going to be at 22. My balance over here as of April 30th is going to be at 20. Uh-oh. There we go. So right over here, my total assets are going to be my cash plus my property, plant, and equipment plus my prepaid insurance, or 356. For April, it's going to be my cash plus the property, plant, and equipment net plus my prepaid insurance, or 408. Now, what's the next step on my thing? I've got liabilities. Okay, what are my liabilities? Well, the accounts payable was already gone through and had been collected. So you're right over here, you've got accounts payable being collected at 30. So that got collected, that balance went down to 0 because I showed that as a disbursement, that is now 0. But I have a loan payable, right? So I have a loan payable over here. Again, you don't have to worry about if it's current or non-current at 200. Don't have any other liabilities. There's no interest payable because I'm paying cash on the loan each month. So my total liabilities is going to be at 200 and 200. When I do a balance sheet, I'm showing that my assets are equal to my liabilities plus my owner's equity. That's the bottom part of the T. So right over here, I now go down over here to my owner's equity. So if I come down over here to my owner's equity, I have 2 parts. I have common stock and I have retained earnings. My retained earnings is what I just went up through over here and did. It's 106 as of March 31st. It's 158 as of April 30th. My common stock balance right over here is going to be at 50 for each month, right? So over here, it's a permanent account. It's on the balance sheet. So my total owner's equity is going to be 156 and then 208. My total liabilities and owner's equity is going to be at liabilities plus owner's equity at 356 200 plus for basically 200 plus 208 or 408. If your balance sheet doesn't balance, it's going to be okay because I like to give partial credit. When I'm grading the balance sheet, what am I really looking for? Well, did you show the prepaid insurance? Did you show the property, plant, and equipment net? Did you show those properly on the balance sheet? That's what I'm looking for, right? The ending balance, if you don't balance at the end of the day, it's not going to cost you that many points because, again, I like using partial credit, especially for a problem that's as challenging as this, right? But we're now going to go to the bonus room or the bonus coverage, right? That's actually kind of bonus room kind of sounds like a how, or okay, that's kind of creepy. But let's just call it, I'm going to go now, we're going to be in the bonus round. Okay, bonus. Okay, now here's what we're going to say. If, and again, this is not part of the question. This is a new part of the question. I'm just showing you an iteration that you may want to study for your upcoming exam. If 20,000 of the 100,000 of sales represented an advance received from a customer. Okay, represented an advance received from a customer. Okay, so 20 of the 100 represented an advance received from the customer. The company will perform the work over, actually, I'm going to change this. We're going to say 18. The company will perform the work over a 3-month, or excuse me, let's do a 6-month period. From 3/1/22, March, April, May, June, July, August, from to 8/31/22. Now, how does this change impact the above? Okay. What I'm actually going to go through and do is I'm going to go ahead and include this in the question, and then we'll kind of see how things change. Okay. So let's take this right up here. And let's put this up here. So we're basically going to add this to the existing question and just kind of go through and talk about how things go through and change. Okay. So when I look at this over here, right, what this is really telling me is that of this 100 of revenues, right, what does it really represent? Well, basically over here, it means that I received cash of, I recorded initially revenues, or the cash revenues were over here of 100, right? So cash revenues are 100, but what this is telling me is that of 18 of the 100 sales during March represented an advance from a customer, right? What that means is, as I look at this over here, when I'm looking at this in terms of using T accounts, right, the cash that I received isn't changing, right? I got 100,000 of cash on 3/1/22, right? But what is changing is what accounts I distributed this to. If I received money on March 1st, that was an advance payment for work I have not yet done, but will be doing over the next 6 months, I'm going to need to credit unearned revenue right over here on 3/1/22. Be very mindful of the dates, right? Very important here. So I'm going to credit unearned revenue. The remaining amount, right? Whenever I make a journal entry, my total debits have to equal my total credits, or this 82 would basically be the regular revenue. Okay. Now, or we'll just say March 2022. Now, when I look at this particular question, right, this is where it becomes really important. What type of account is unearned revenue? It is a liability. If this doesn't make sense, you need to go back and look at this homework packet here in particular. So if I'm looking at this 18, right, it was originally recorded as unearned revenue. But how do we go through and account for it? Well, let's take a look over here. It basically tells me I'm going to be doing the work over a 6-month period from March 1st through August 31st. So what am I going to need to go through and do? Well, it's 18 is the amount of the advance or the unearned revenue. And then the months of service is going to be 6. So the amount of revenue I'm going to recognize every single month on this is going to be $3,000. So what happens here? Well, to recognize the revenue, how do I make the adjustment? Well, for the month of March, I'm going to go ahead and debit unearned revenue. And I'm going to credit revenue for 3 and 3. Don't have to do this, just showing you how this works. So I'm going to credit revenue for 3. This is my adjustment. And so right over here, my total amount of revenue for the month of March is going to be 85. My unearned revenue is going to be over here at 3. Excuse me, it's going to be reduced by 3. And this amount will be at 15 as of 3/31/22. Let's make sure this makes sense. I got an advance. It was 18, 6 months of service. 1 month has gone by. So I still have to perform work during April, May, June, July, August for 5 more months. 3 times 5 is going to be 15. Let's go through and see how this changes our answer for the month of March. So right here, my revenues are no longer going to be 100, but my revenues here are going to be at 85. Okay, my revenues are now going to be at 85. Also, when I come down over here and I kind of look at this, right? So it changed my ending retained earnings. Nothing else is really changing, but I've got kind of a problem. My assets are still 356, but my liabilities and equity are now 341. So what am I missing here? Well, the unearned revenue is a liability because I have not yet performed the services. So over here, underneath loan payable, again, doesn't matter the order you put it in, I'm going to have unearned revenue. The amount of my unearned revenue as of March 31st, which is the month I'm doing, is going to be at 15. So my total liabilities are now going to be at 215, and everything is now balanced in my balance sheet. So again, because I made this hypothetical, 100 of this, 18 of it was not, it was an advance. So what I have to go through and do is I have to say, let's isolate that advance out of the revenue, which is what I did right over here. Then what I need to go through and do is recognize part of that revenue during the month. So I come right over here. And how has that changed my result? Well, my revenue went from 100 down to 85 because I can't recognize that 15 yet because I haven't done the work, but nothing else here is changing. Right now, over here, my net income is going to be different. And then over here, dividend, nothing here is changing. And then in terms of the balance sheet, though, what's happened? I've added in a new liability account, which is going to be unearned revenue. So this is going to be at 15. My total liabilities are now 215. My total assets are now 356. This is basically my retained earnings also changed. So that's how we're getting to that result. Now let's go over here and look at the month of April. So for the month of April, okay, so right over here, and we're not really given any other information, right? So right over here, my revenue for the month of April was 120. That's not going to change, right? That's going to be because there's no information about an advance from a customer during that month. However, I have unearned revenue, right? I have unearned revenue, which had a beginning balance on 4/1/22 of 15. How much do I recognize during the current month? Well, it was over 6 months, so it's going to be another 3,000. So here, I'm actually going to be increasing my revenue right over here for the 3 because I'm earning out this particular revenue. So when I come over here, my revenue for 4/30/22 for the month ending, that is no longer going to be 120. My new amount of revenue is going to be 123. That's my new amount of my revenue. How does this impact what I'm doing? Well, the ending retained earnings became the beginning. My net income is slightly higher, still have the dividends. My ending retained earnings is here at 146. Nothing's really changed over here on my asset side. It's still at 408. I have liabilities in terms of the loan payable, but now my unearned revenue account, is it still at 15? Well, the answer to that is no. It's now at 12. Why is it at 12? Because I still have to perform services through the month of August. So I have to do May, April, May, June. Sorry, May, June. Oh God, May, April. Wow, it's probably 420 tomorrow. I've got over here, this is going to be May, June, July, August. 4 months at 3,000 per month. So my unearned revenue is going to be at 12. So over here, total liabilities are going to be at 212. What else has gone through over here and changed? Common stock, my retained earnings went up. I reflected that here because I linked the cell, and that's giving me my total liabilities and equity. So I'm calling this a bonus because I will put something like this onto your exam. But at the same time, it's something that if you don't understand this part, and again, when you take a test, what's really, really important to do, whether you're in my class or any other class, and I had a conversation with the founder, Joey, the founder of Universal CPA Review. And our comment was like, when you take the CPA exam, and this really goes for any test, you want to start with the questions that are easiest for you first. Build confidence. You have to do that when you go into an exam. If this is too complicated for you, or if you didn't have a good financial accounting base, do this last. Don't do this question first. Do it last, right? This is very tricky. But again, hopefully this helps you in terms of going through and preparing for any type of instructor that's going to go through and give this type of test. But this is really about how challenging I can make this particular test. And again, feel free to leave a comment. And I want to thank you for liking and subscribing. And just give me one moment. And if you have a question about the video or anything else, again, I want to thank you for liking and subscribing and really appreciate your time on the channel. Have a great rest of your day. And I look forward to seeing you on future videos. Have a great one.